are the major challenges we help address. So again, we want to keep it very easy for folks to understand. We're going to some customer success stories um, just to highlight and articulate that, and then we can let Jim go into the financials. Um, so here for professional services, we actually this is one of the Big Four professional accounting firms, consulting firms with over 500,000 users. They're facing mounting risk from ungoverned Microsoft 365, which is Office Cloud tenants, as they roll out Copilot. This is happening across the board, all the biggest banks in the US as well. They roll out our governance solutions for Teams first before they roll out Copilot for Teams, because Copilot for Microsoft Copilot, Office Copilot, it grounds on Office Graph. So if the permission structure of the Office Graph is not set properly and no one has it set properly, ask your business users when's the last time they actually paid attention to how permissions are set and how long they should be set for specific digital assets, right? No one has the time or even the sophistication to do that in a proactive way. You have to have software to do that. So we do this in an automated way for this very large global four consulting firm with 500,000 users to help them centralize and simplify management around their security and compliance settings. So the net is that they were able to reduce data sprawl and then be able to allow for delegated administration so business user can provide context so that there's proper governance and guardrails around the data sharing and data lifecycle, and even now extending to agent lifecycle, because IT doesn't really know what these data and what these agents are created for. So this is something that's really unique that avepoint offer, this delegated accountability, a delegated administration to give context to the way data being managed and curated. So net of this is that this organization is able to roll out Copilot much, much faster than they had anticipated. Next one. So this is the insurance example. So it's a US insurer with 25,000 users that needed a governance framework to scale, again, their Office 365 Copilot deployment, addressing risk around unstructured data and unstructured data areas. So specific data rooms, specific folders, share drives, teams, channels to be able to be compliant and while enabling Copilot. So same story there. We empower them to do this. So now we have very nice playbooks, copy and paste cookie cutter playbooks for the insurance sector. Next slide. This is a healthcare example, 9,500 users. They need to replace legacy tools to ensure ransomware protection while have the proper governance and reduce administration cost. So again, multiple tools across our confidence platform to help them do this. Without us, they would have to choose at least 3 different vendors, 3 different experience, 3 different contracts, 3 different support infrastructure. So this streamlining of a unified way to modernize their data protection, ransomware recovery, and governance of data and reduce administration costs is something that they got with avepoint in a highly regulated industry. Next one is actually a global consumer packaged goods CPG leader with 130,000 users. This really showcases you the diversity of industries that we cover. This is packaged consumer goods environment, again, leveraging Microsoft Cloud as mission critical. So there we actually allow them to save massively their storage cost by archiving and do very sophisticated tier storage management, while also have governance solutions to streamline data curation and data management for them to roll out a much more compliant cloud data estate while saving cost and ensure governance. So this is a consumer goods example. And lastly, it's another Big Four company with over 400,000 users that want to identify risks. What content in their environment have been overshared or internally, externally, and they need to shut down. And also they need to be proactively protect against. So again, this visibility into content overexposure and implementing governance policies to ensure their readiness for AI. So we have done this and cut short significantly their AI readiness assessment and AI ready posture to allow them to enable rollout of AI across the entire organization in the form of Microsoft Copilot. So hopefully these customer examples showcases to you our capabilities across the industry, across companies big and small, and across geos of the type of very hard challenges we help enterprises solve today. So with that, I'll pass it over to Jim on financial highlights.
Thanks, TJ. We can go to the next slide, Jamie. So, we believe we have a very compelling equity story, and maybe the best way to summarize it would be into these three really key points. First is that we believe we have tremendous growth potential, kind of what just dovetailing into what TJ just mentioned about the tremendous opportunity in terms of our TAM. Not only is it massive today, but it's continuing to grow and expand. So great opportunity in terms of the markets we play in, great potential there. We do have a great diverse customer base, as TJ alluded to. Some of the examples show some of the larger organizations that we've dealt with, but we really participate in all three segments from enterprise, mid-market to SMB. So again, really every customer can benefit from the solutions that we offer. And then third, and certainly not least, is the strong financial performance that we've demonstrated now over the last particularly 10 quarters, really demonstrating durable top-line growth, improving profitability, and again, maybe most importantly, strong free cash flow generation and performance. So when we think specifically about Q3, here are definitely some of the highlights. I know there's a lot of words on this page, but we'll get into some of these in a little more detail on the subsequent slides. But it really starts at the top line for us, which is that annual recurring revenue that TJ mentioned. Really this quarter growing 26% year over year to reach that $390 million mark. Very good growth across all three of our major geos from North America to Europe and APAC. Really good growth with APAC actually growing the fastest. So really good progress and good growth there. The SaaS, software as a service revenue, grew 38% year over year. So again, really strong performance in that segment of our business. Total overall revenues grew 24% year over year. And then our retention metrics, which are key for any SaaS business, it's how well you're retaining customers as well as growing those existing customers. Those are the next two components here. And at 88% and 110% respectively, really healthy retention metrics that we're again continuing to see improve. And so we're really pleased with the retention metrics we see. And then the last two in terms of kind of profitability from an operating margin point of view, and then a free cash flow point of view, really healthy performance here with operating margins of 22%, which is continuing this to improve. And then our cash flow generation, which this quarter we hit a record $34.8 million. So again, strong financial results for the quarter. Just touching on what we refer to as our three key metrics, and these happen to also be the three metrics that we guide to on an annual basis. First, on the far left, you have our annual recurring revenue, and you can see the steady progress that we've made. This is comparing Q3 over the past 3 years, and you can see that steady improvement across each of those 3 years. In the middle, you see our total revenue. Again, a similar trend here over the last 3 years, really steady, nice performance, nice growth, and again, reflecting all three of our key regions performing very well. And then on the far right, you have our non-GAAP operating income. And again, you see nice steady performance over the past 3 years, and again, good contribution from all of our major regions. This hopefully gives you a sense as to really the balance that we have in our annual recurring revenue base. And so we look at this slide as a way to just kind of divide and provide a little more color around our customer base, really. And on the left-hand side, you can see really the slices represent the industries that we participate in. And pretty much there's not an industry that doesn't have the same challenges that TJ alluded to earlier, from governance, all types of data security issues, governance, all generally data management in general. And that's where we play, and those are the solutions that we provide to our customers. And it's really every industry benefits from those solutions, as every industry has the same set of challenges and problems. And you can see here pretty good diversity amongst our industries. We started out really in the heavily regulated industries. So when you think finance and insurance, healthcare, government, so those today still outweigh some of the other industries. But again, they're all growing very nicely, which is, again, a testament to the teams that we have out there executing very well. And then on the right-hand side, you can see some of our ARR by, again, different slices, everything from geography at the top, where, as TJ alluded to, very good balance across all of our regions, with, again, APAC growing the fastest. So we're really happy to see that performance. And then everything from how we go to market, direct versus channel, very well balanced, new versus existing, how many new customers we're adding, and the revenue coming from those customers versus our existing customer base. And you can see that we actually generate more revenue from our existing customer base, which is great to see because it demonstrates two things really in my mind. One is that we have happy customers who are consuming, they're happy with the existing solution they've purchased, and so happy that they're willing to again re-engage and purchase more from us. And it really demonstrates our land and expand strategy, or our platform play, where we have a platform that gives our customers a unified approach and interface, but allows them to solve multiple problems. And again, consume more of that platform, purchase more from us. So again, it bodes well for the future as those customers continue to spend more and more with us on an annual basis. And then the product suites, again, we group our products into categories that we call suites. It's just an easier way to describe the business, and you can see good performance, good balance across all three suites. And again, all are performing very nicely. And then last is that customer segment that we spoke of earlier, when we have enterprise, mid-market, and SMB. In this area, SMB is our fastest growing segment, represents just under 20% of our total ARR, but again, is our fastest growing. And we see the most promise here, where we have an enterprise grade solution that is available to our SMB markets predominantly through managed service providers. But again, this really bodes well for that SMB group because they ultimately receive an enterprise grade product, but in a more manageable cost, and they're able to consume it. So again, hopefully this gives you a little bit of a sense as to the balance of our company and our customer base. We spoke of these retention rates earlier, and so we've kind of divided them into two, our gross retention rate and our net retention rate. So on the left-hand side, you see our gross retention rate, which you can see going back 3 years was about 87%. And now we've been pretty steady at 88%. And this really reflects your ability to retain customers. It's a pretty common SaaS metric, software company metric. Again, ours is very healthy at 88%, which shows some nice improvement over the past couple years. And again, our longer term target here is to get to 90%. So we believe we made good progress. We've implemented a number of strategies that will take us from this 88% over the next couple years to get to that 90%. So again, we feel good about this. And on the right-hand side, you see our net retention rate, which just a couple years ago was 108%. We're very pleased to see it at 110%, and our longer term target here is to get to 115. So this slide divvies up kind of a couple factors here, but really talking about our operating leverage. We made a commitment 3 years ago, really to focus on profitable growth, and I think this slide helps kind of demonstrate and show our execution against that goal of profitable growth. And you can see on the left-hand side, we're talking about revenue and gross margins, where you can see that steady improvement in revenue and a steady improvement in gross margins from 2023 to 24, and pretty much fairly consistent here in 2025. So good progress in terms of growth and that first metric of achieving more gross margin. So solid performance there. And then operating expenses. So in this chart in the middle here, you can see that back in 23, we had fairly high operating expenses from as a percentage of revenue. You can see our sales and marketing were almost 40% of our revenue. G&A was almost 17%, and then our R&D was in that 12% range. We do want to keep that R&D somewhere in that 11 to 12% range. We do believe this is the lifeblood of the company. So we want to see that stay steady, and it's remained within that range for the last 3 years. But what you can see is our sales and marketing expenses we've significantly generated leverage there, going from that just under 40% to in Q3 on a trailing 12-month basis, we're now at roughly 32%. And the same thing with G&A, taking it down from just under 17 to the 13.5% you see on the screen. So again, we're seeing nice leverage, combination of us managing our expenses and then obviously growing our revenue base. And then that obviously results in the far right-hand side, which is to see an improving non-GAAP operating margin from as low as 5% back in 2023 to now over 18% in Q3 of 25. So again, strong performance on a trailing 12-month basis. And this is really, setting us up to hit our longer term targets, which are above these numbers as well. We talked about obviously operating margins, but obviously, cash is king, and ultimately, what you're seeing here is strong cash flow generation. So back in, again on a trailing 12-month basis, but back in Q3 of 23, we were generating about $17 million over the past 12 months. That's steadily improved last year to 74, almost 75. And then now this year, we're standing at almost 85 million on a trailing 12-month basis through Q3. So again, steady performance, execution, and that leverage you saw on the prior page is translating into improved cash flow this year. We get often asked them a lot about our capital allocation. We have a significant amount of cash on the balance sheet at this point, just under $500 million of cash. And so the question often gets asked, what are you doing with it? And so we break our capital allocation into these three priorities. First is making sure we're continuing to invest in the business, ensuring that our teams have the appropriate resources, both from a people point of view, but even nowadays, more importantly, from a technology point of view. And so that's first and foremost, making sure the teams are set up for success and that they can continue to grow. The second is supplementing our existing development efforts with M&A opportunities. And the next slide, we'll go into some of those in detail. But we've done a fair amount of small, what I would refer to as tuck-in acquisitions. But we're in a position now to even do larger acquisitions with the strength of our balance sheet. And then the third is share repurchases. Since we do have this strong balance sheet, gives us lots of options and opportunities to not only do M&A activity, but also to look at maybe repurchasing shares as, again, a way to capitalize on opportunities both externally in the marketplace through M&A, and then also repurchasing our shares when we believe the opportunity arises. So again, we've done this to a measured degree, and we'll continue to do so going forward. That M&A we talked about, you can see we've done 6 transactions here since going public. All of them, like I said, small tuck-in acquisitions. and all have been, for the most part, for technology reasons only. We are looking to maybe expand that and do acquisitions that could be a little bit larger in scope and not only provide us great technology, but also potentially enhance our customer base as well. So, we're looking to do more of this moving forward. But again, I think we've had a good track record of success with our smaller acquisitions that gives us the confidence to actually, do larger acquisitions moving forward. When we think about our guidance, in terms of how we think about communicating externally as to what we're going to do, you can see here on the left-hand side, this is our expectations for Q4. And on a quarterly basis, we guide to both revenue and operating income. And on an annual basis, we also guide to ARR. And so on the left-hand side, you can see we're guiding to record growth in our total revenue numbers, reaching 110 to 112% as a range for Q4, and then our non-GAAP operating income being roughly 21 to 22 million. So again, we're projecting very strong performance to end out the year on top of what we've just completed for the first 9 months. So again, really pleased with the team's execution across the board. And then on the right-hand side is our guidance for the full year, which obviously takes into what we just communicated about Q4 in terms of expectations to what we executed for the first 9 months. And again, you see here very strong growth rates from our ARR at 26 to 28%, revenue at 25 to 26, and then non-GAAP operating income margins in the high 18% to 18.6% to 18.8%. So again, really favorable when we compare that to the prior year's numbers. And again, we feel really good about the performance of the team and happy to share kind of the guidance for the full year. Next slide. And then maybe that brings us back to just as what we believe is this compelling equity story. So hopefully what you've heard from TJ and some of the financial performance, you're kind of seeing the same conclusion and opportunities that we see, which is tremendous growth potential, which we believe we really have this great team to go after and customer base to penetrate that gives us the confidence that not only is there a great opportunity, but we're in the right spaces at the right time to address the customer needs and really enhance our customer base. And then ultimately, we believe we've got the team in place to deliver strong financial performance and continue what we've been doing really for the past couple of years. We think we have a track record to do that. We think the opportunity's there, and we think we have the team in place to go capitalize on the opportunities in front of us. And frankly, we're excited, to continue to go to battle every day and deliver strong performance. So again, with that, I think that'll wrap up kind of our prepared remarks, and we're happy to open it up to questions, and would love to, talk more and take your questions.
Right. Thanks, TJ and Jim, for the sharing. Right. So we will now head over to this discussion, right, for us to share and also understand more about the company. All right. So if there's any questions from the audience, also feel free to put them in the Q&A itself so that we can also address them along the way. So to guide the discussion along, so I will start first. Right. So maybe first off, I think avepoint might not be familiar for quite a few of our audience today. So maybe you can just explain a bit more of what is the company about and what is this confidence platform and what it does, as well as what is the main problem or the issues that you do help the clients solve, and how do they use your products per se. And the key thing is actually, I believe, will be then how you derive the revenue from such services that is rendered to the clients. Yeah. And then maybe some examples here and there and how they actually use and also integrate your solutions with their operations.
I think that was our presentation about what we do and the customer example. But again, just rehashing, we are a software provider, so it's a software as a service. So it's 88% of our revenue come from recurring software subscription, operating at low 80 to mid 80 profit margins, and then about 12 to 13 services at lower margins. So the blended margin is about mid 70s, right? Our medium to long term goal is to get that to 80 something. The things we address is we have a unified cloud-based platform. Today, we ingest about almost 700 petabyte of data on a daily basis across 25,000 customers around the world. We're increasing our customer base at a fast clip, like 21% year over year. We have customers in large enterprise, mid-market, SMB. We help them fundamentally is to manage data, backup data, restore, ransomware detection, restore, and then also govern how long those data can live for, who has access to it, for how long, internally, externally, and how do you save costs. We also have license management, help customers save costs, help customers move data between clouds. We do have multi-cloud strategy as well because most customers have multiple cloud. So we can do this not only for Microsoft Office Cloud, but also for Google Workspace. So think of Gmail, Google Docs, and also for Salesforce. Think of CRM. Recently, we just announced support for Okta, for Confluence, for Monday.com, and many other sources. So within the Microsoft ecosystem, we are the largest global cloud-based software as a service, data management, data governance, data security player. So that's what we do. It's one singular software, but we have multiple instances around the world for data sovereignty concerns, for performance concerns, and also in government data centers for high security environment. So we have a lot of certifications, whether it's ISO or ISMAP is in Japan, and Fed certification in US, and in Singapore even we have ODC, so offshore dev security clearance certification. So our Vietnam dev centers can work on Singapore government projects. So we do all these things for customers. Overall, is to help them work more securely and more confidently. Also, to be able to roll out AI in a more confident manner. So AI doesn't give you over risk exposure, doesn't give you misinformation. So this is a collective what we do. So the customer example we did cite in across verticals, across government, across insurance, compliance, FSI. Our website, we have many customer case studies listed by country, by geo, by use cases, by product. You can take a look at that. It's sufficient to say, and also we have, you can look at Gartner insights about our rankings, G2 insights about our rankings for enterprise customers, for SME, mid-level. Today, earlier in SGX, we talked about the awards we have won, right? There's 100,000 Microsoft partners. It's very hard to get global awards. We got 7 times, and we got it in public safety and security, which is fantastic for government. We got it for Japan, which they usually never give to non-Japanese companies. And we got it in education, which is the IP we generated in Singapore, where we dominated the IHLs, so all the polys, unis, even NTUC, Learning Hub, their learning experience platform is ours. So we dominate these industry vertical use cases, very much focus on securely and confidently collaborate to increase speed of collaboration, and also rolling out AI.
All right, thank you. So the next point actually does gel with one of the questions that we have received from the audience. All right, so main thing is we do believe what you're sharing that it might be relevant, and also the company's offerings is there. So maybe we can actually talk about next is how the growth of the company, the products and offerings is expected to be, because we do expect maybe there might be a large addressable market and a serviceable market, but whether or not is the growth going to be large, and what is the underlying reasons that might drive the growth, as well as what is the key main advantage for avepoint on it being a one-stop solution, and how are these competitive advantage helping this helping the company stay relevant? Because the questions that the audience is asking is, given how much is tied to Microsoft, is there any risk if Microsoft eventually come out with their own competition in terms of the software, in terms of offerings? Is there any risk, or is there any replacement risk in a sense from the thing? So I think competitive advantage would be a key thing that you can share with us.
Yeah, I'll just address the Microsoft side, and I can have Jim talk a bit about the TAM and long-term growth, why we're so confident on the target. We don't compete against Microsoft. We compete within this multi-trillion dollar hyperscaler ecosystem. We are the largest ecosystem player in the Microsoft ecosystem. We have a 9-digit relationship with Microsoft. We don't sell their software, nor do they sell ours, but we consume Azure, we consume AWS, we consume GCP to do what we do. So we're in cloud, we're natively cloud. So to the Microsofts and Googles, we are actually their last mile partner. So they actually really appreciate what we do in lighting up their advanced workloads like Purview, E5, lighting up Copilot. We give many examples where before big banks and big consulting firms roll out Teams Copilot, they first turn on our governance solution for Teams. So effectively, we're actually lighting up workloads. So this is only beneficial to the hyperscalers. Now, why wouldn't hyperscaler do what we do? Well, we've been doing this for 25 years. There's always, at times, they will incrementally improve the baseline. But what Microsoft and Google do is they do the baseline, right? They do the big platform. They're going after the $100 billion, opportunity. There still leave much opportunity for monetization for the ecosystem to close out the specific things. So for example, we understand Singapore government needs better than Microsoft because we're here, we're doing accounts there. So we have specific local regulations that we cover, like IM8, for example, that we can then help light up and help them use more of their existing investment already in Microsoft stack, right? So we actually are very beneficial in the ecosystem to on one hand, allow customers to maximize their investment. On the other hand, allow Microsoft to see more workloads light up, more tech being used. But we are, of course, our number one primary driver is to help customers. This is where multi-cloud comes in. All customers have multi-cloud by definition. So it's not in the interest of Microsoft to help customers on Google, vice versa. We do, right? We help them coalesce and have a unified strategy around data governance, data management, data security across multiple environment, across hyperscalers. So this is why we continue to be very, very relevant. In terms of TAM, it's a massive TAM. So even just the governance risk and backup and replication TAM is about 19 billion. That's our core business. Adjacent TAM, that 10 billion is data integration, data analytics. Think about Informatica, right? In the 19 billion, think about the old brands like Symantec. And then in the immediate adjacency is security. So we talk about identity, access control. We talk about endpoint management and native applications, guardrails, like we talk about Power Platform governance, now agents governance, agentic governance. There's another $50 billion immediate TAM. So it's a massive $80 billion TAM that's growing very rapidly. So that's the market we're going after. So Jim, maybe you can talk about the longer term goals.
Yeah, I was going to say if Jamie could go to that slide, then that could be the backdrop for for that conversation. I think it's slide 26,
26.
Jamie.
Yeah.
Yeah. Um,
There we go. Yeah.
yeah. So again, the last part of that question, talking about like our longer term targets, you can see here that we talked at our investor day back in March about getting to $1 billion in 2029. So we've kind of anchored all of our longer term targets around um, this $1 billion target. So that anchors us to roughly 2029 on these longer term targets. And you can see here that our gross margins, which today are in that 75-76% range, climbing to 80% over the next few years, partly as the mix shifts a little bit. TJ alluded to that our services business is lower margin than our product business. The products are in the 80-85% range. And so as the services become a smaller percentage, which we expect, right now they're around 13%. We would expect them to get slightly under 10%, roughly around that range. So as that product mix shifts, you'll see an improvement in margins. And so again, longer term targets are around 80%. We talked about our operating expenses, the sales and marketing, R&D, and G&A. So you can see here continued improvement, and we expect sales and marketing to roughly get to about 30%, really demonstrating that leverage We're doing more and more through what we refer to as the channel or that indirect strategy, which again is highly leverageable. It's the concept of obviously, reaching many more potential customers than we do today on a direct basis. So again, we're continuing to use more and more of the channel. So we'll see that leverage continue. R&D at about 12%, and G&A getting down to about 10%. So again, all of that translates to improved operating margins from the 22% we just saw in Q3 to roughly about 27%, 27.5% by the time we get to 2029. And then the last piece, that stock-based compensation, which for a lot of software companies is very high. This last year in 2024, we were at about 12%. We're running right now around 10%, and we would expect longer term to be, well under 10%. So hopefully that gives you a flavor as to the longer term profile, financial profile of the business.
Right. Thanks for the sharing once again. Right. So maybe I'll also try to link up some of the questions that we do have. So we do have some questions from the Q&A from our audience itself. So one is question is avepoint the market leader, and who are some of the main competitors, which is a few questions on that, as well as if a competitor comes in and just copy the business model, is it possible? Is there any moat or protection around what your business offering have? And in relevance to that, because you all mentioned that your business customer segment is enterprise, mid-market, and small SME business. So what is the main focus currently your company might be focusing on to grow? And is it because there's the growth is the largest engine there, or is there any other main reasons for such a choice?
Yeah, so I'll take the first part of it. So from a competitive landscape, we don't have a singular competitor. We have different competitors in different space and also in different customer segments. So this is also uniquely beneficial to us, right? We're able to sell the same enterprise grade software to the Fortune 50s as well as to the five-man small businesses. How we did it is we were able to have an intermediary. Small business don't have IT, so we find this intermediary, which is outsource IT, that increasingly have a recurring business of managing cloud assets for small businesses. It's no different than in Singapore, you have your AC service guys come in every 6 months to service your AC, right? That's a recurring business, managed services. So think of those type of experts. They are effectively to us pretty sophisticated mid-size IT teams because they're behind them. They're handling hundreds, if not thousands, of small businesses. They use our software to scale their business, right? To provide data protection, to provide license control, to provide data movement, migration, and management for their customers. So that's SMB. So there we have different competitors versus enterprise. Historically, it's different type of companies. So that's what makes us unique. So in enterprise, for example, in backup, we will run into some legacy player like Veritas, which just got bought by Cohesity. It used to be Symantec. And of course, there's some company like Rubrik, right? That came from the AWS space, starting to go into Microsoft. In the SMB space, in Singapore, people probably heard of Acronis. They just got bought by PE company. And then there's also Veeam, right? That's 80% of Veeam business come from companies with less than 100 employees. So for us, SMB is less than 500 and below, right? So that's about 20% of our business now, SMB. And 30% is mid-market, 500 to 5,000. And large enterprise is the other 50% of our business. So in all three segments, they're growing very, very nicely. So that's a good thing. SMB is growing the fastest. It's a power of long tail, higher margin. That's really good for us. For Microsoft, it's 40% of their business. So we are seeing high growth in all major geos and all major segments. That's what gives us the confidence to hit our, guide of 25% CAGR year over year from now all the way to 2029, because the market, it's quite large. So from a competitive landscape, because we have point competitors in different spaces, and because we have different competitors in different segment, and we also have different competitors in different geos, that give us a collectively advantage of platform where we go to customers and say, hey, rather than multiple vendors you have to deal with, vendor consolidation, less throat to choke, but also importantly, I think this is one of the most underappreciated aspect of investors first looking at AvePoint is our capability around security, around be able to protect our data, our customers' data. Like I mentioned, we ingest about 700 petabyte data on a daily basis. And we, like Microsoft, is getting attacked every single day, right? By different type of cybersecurity, cyber syndicates or state-sponsored attacks. We are able to build that sophistication over last 15 years, and that's something a lot of these guys, because they're either legacy, just going to cloud, or startups born in cloud, but they don't have the sophistication, they lack. This is why companies come to us. Not only do we have full-fledged platform end to end, we also have the peace of mind and assurance that their data is safe with us. So these things allow us to compete very effectively in the field. So we have always done historically direct sales. Since we gone public in 2021, we made a very conscious and aggressive intentional move to do channel. That's what also accelerate our growth, but also at the same time lower our cost of sales. So our, like Jim mentioned, our sales and marketing cost was 44% of revenue for 2021. Now, latest this year is 34%, and we're going down to 30%. That direct savings goes straight to the bottom line. So the reason why we use channel is while we have a high rate of winning when we do the one-to-one bake-offs in enterprise, I say to my enterprise sellers, there's 99 conversation we're not in. So we need to leverage the power channel because the market is much, much bigger. And we're still a very small company relative to the market. So for us to scale, we have the best product. For sure, we have the best product and we have the best footprint. So now we need to truly scale across all segments, across all geos. And that's our continued investment into channel.
Right. Thanks. I think that's a very elaborate question, answer, which is good. I think that helps target on some of the questions on competitor. I think we do have a question on that. All right. Next one, maybe we can discuss on the fact is that I think just now you also mentioned slightly from Jim regarding the gross margins, operating margins, and cash flows. So the growth and also the improvement you mentioned already. So is there any long-term plans in this case? Most of the questions from the audience these days is that would there be eventual dividend policies that you are looking at, or are you looking at just mainly on the capital growth of direction for the company while doing R&D? So most Singapore market, some of the investors do look at dividends. So I think that's why the questions came in on the aspect. And maybe you can also couple this with any milestones you can look at for the upcoming year or something.
Yeah, it's a great question. And I think what you'll find that in most software companies that are growing, still have an unbelievable TAM that they're trying to go after, that very unusual for them to be issuing dividends. Now, there are exceptions, obviously, like the largest companies in the software space do pay dividends, but we're still in the mode of reinvesting and looking to expand and continue to capture growth. And you can see Jamie put up on the screen here our capital allocation priorities. So when we think of our balance sheet and we think of the cash and even excess cash, we think about these three priorities today. And so you can see on the far right-hand side, the share repurchase. Many people would refer to that as a pseudo dividend because obviously by repurchasing shares, you're actually increasing the value of each of the remaining shares. And so, that's been our strategy to date is to utilize these three allocation strategies. Again, making sure the business has what it needs to grow. Two, looking at acquisitions. You'll see in our space, there have been a number of acquisitions. It's a pretty acquisitive space, and I think you're going to continue to see more consolidation in the space. So I think we want to be prepared to take advantage of being on the right side of some of those moves that are going to be happening over the next couple of years. And then again, third would be the share repurchases, which again, I think you'll continue to see us do. So that's really how we view, think about dividends. And I would say that's definitely for the foreseeable future. Doesn't mean that that might not change a little longer term, but at least for the foreseeable future, that's how we think about capital allocation.
Okay, so I think we do still have some questions coming in. We might not be able to answer all of them, but let me just try and integrate them as much as possible. Right. So there is one question regarding how important acquisitions is to your growth direction, the engine, and whether or not there's any strategy involved and anything we can share on it, as well as what is any recent acquisitions that you can share on for your company. And is it mainly to fill in any gaps in the offerings, or is it just to enhance the geographical direction or the reach outreach itself? And along with that, maybe you can just also share on the fact that how investors should then evaluate SaaS companies such as avepoint, all right, and what's the key metrics that people can look at as an investor to actually pinpoint or maybe evaluate what is a good company in this industry to invest in.
I'll leave Jim to talk about the key metrics that people use to evaluate SaaS companies, Rule of 40 and Rule of X and all those good things.
Yeah.
I'll just talk about the M&A strategy. Here you see on the screen here, we done 6 acquisitions, tuck-in acquisitions so far, all under 20 million, and they're different parts of the world, you would notice. Very interesting, right? We are global. So we source deals globally. So Singapore, South Korea, UK, Canada, Netherlands. And our strategy has always been acquiring IP that we can organically integrate and then deploy out to increase the growth rate, increase the ARPU, if you will, basically increase the total amount per seat that we can sell because you're expanding the capabilities for our platform. So as tech leaders, tech founders, we are very, very mindful of doing acquisition right. So we see many cases of tech companies who are doing acquisitions for the sake of revenue growth, and then they end up accumulating a ton of tech debt. So the products are not integrated. They're different experience, different support system, different code, and over time they just get way down, right? So and they stop innovating. So that's not the space anyone wants to be in, especially in our space. It's an innovation-driven, highly agile space. I'll give the example of the Identic acquisition in Netherlands. We did that earlier this year. It's been a fantastic acquisition. We already organically integrated into their solutions, growing very, very nicely. In the SMB side, we're growing 50%, right, year over year. And that's first and foremost an SMB solution that enables MSPs, managed service providers, to have more use cases of our solution, going to device management, going to license management, cost management. And this is where for every dollar the MSP spend with us, they generate $5 of revenue, right? So think about once we get to 1 billion, and if we now think SMB could be 30, 40% of that, let's just say conservatively 30%, right? That's 300 million. And factor 3 is $1.5 billion revenue that can be generated for our partners just in that SMB segment. That's fantastic, right? And now we can extend that to mid and large. We actually see some of the SMB use cases being now deployed and bought by some of our largest customers because to them, they have multiple tenants. They also have same pains of baseline configurations, of license management, saving costs, and they're also using some of the use cases. So it becomes a virtuous cycle. So our acquisition philosophy is to make sure that it's an organic expansion of our platform so that it's a very easy conversation to do the upsell. It's a very easy conversation to discover the need and be able to highlight those additional need to solve the pains that our customers and partners today experience. So some of the things we highlight in other calls is, for example, today we very much focus on unstructured data, but we have opportunity to extend our capability around structured data, right? So unstructured data is 80% all data, and there's structured data. And then also, what we talk about is today we make a revenue mostly on collaboration products. So Microsoft Office Cloud, Google Docs, Google Gmail, and of course Salesforce. But there's a whole side of space of IaaS, PaaS. So that's Azure, that's AWS, that's GCP, that's growing 30+%. Microsoft Office Cloud is growing in the low teens, right? So we're growing, 20, mid 20s, right? So now we're actually extending to cover the IaaS and PaaS, so applications, raw data, workflows, VMs. Those are also things that need to be governed, need to be disaster recovered, need to be backed up, need to be migrated. So we're extending aggressively into that space, and that's even faster growing and even bigger TAM. So those are the spaces that we are looking to acquire additional capabilities on top of organic expansion. Lastly, I would say is in the multi-cloud expansion, specifically Google, AWS, and Salesforce. We have products there already, but sometimes in the B2B world, it's very different than B2C world. B2B is the harder part is also, it's not just the product, it's also the go-to-market execution because it's a different ecosystem, different players, different partners. It takes time to build that relationship. If we were to acquire players already in that space, that would speed up our time to go to market. So there's also opportunities there. So there's multiple things that we can do to expand. Having said all of that, we do not depend on acquisitions to hit our 1 billion ARR number, right? So we have multiple avenues of growth. If all of them hit, we will grow faster, right? If half of them hit, we'll still be able to. We always, since being public, given numbers that we must hit and ideally beat and do it earlier. We reach GAAP profitability earlier. We reach Rule of 40 earlier. So these are the disciplined approach we have to our performance. Jim, you want to talk about the
Yeah,
top
maybe
SaaS metrics?
yeah, I'll just add a couple quick comments on that. So, you mentioned about like valuation and what investors should be thinking about. So, one of the keys is, obviously growth is important, and so a lot of what you'll see software comparisons and valuations will be driven off of revenue growth or ARR growth. So you'll see that as kind of like a multiple. How people think about the valuation. It would be a multiple of either revenue or ARR. And then the key, as TJ alluded to, is this rule of 40 concept. And that's really a concept that's really thinking about profitable growth. And so we've talked a lot about profitable growth. And so that's really the focus on the rule of 40. So what the rule of 40 does is it takes two metrics into place. It takes a growth metric. People sometimes use ARR growth, which is what we use. Some other people will use revenue growth. And then they add to that growth rate some sort of profitability metric. It could be a free cash flow metric. It could be a non-GAAP operating metric. It could be either of those two. And you see on the screen here what we're talking about in terms of that rule of 40 on the left-hand side is our metric. And you can see through 2024, we were at a rule of 38. We're now above the rule of 40 in 2025 even on our metric. If you look at the metrics that many other people use, which would be revenue growth and free cash flow margin, you can see that even at the end of 24, we were above a rule of 40. And then the rule of X is to the far right, and this just weights growth more than the profitability metric. You can see like a 2 versus 1. In the first two on the left-hand side, the rule of 40 weights profitability and growth the same. So it treats them as a 1 for 1, and the rule of X weights growth higher. So the beauty of this for us is that in either of these scenarios, as you can see, and particularly in 2025, we will be above that rule of 40. And the importance of this metric is when you look at companies that are above the rule of 40 or below the rule of 40, the valuations are very different. So you want to be in the camp that's above the rule of 40 because you're demonstrating two things to the investment community. One, you can grow the business, and two, you can do that profitably. And so that's kind of where we are. And we're excited about being able to put another column in this chart of 25 that would have us securely above the rule of 40 in any way that you evaluate.
Right. Thanks. I think we are also approaching the end of the session. So maybe just for the last part, maybe you can see who want to do a summing up on why investors should be actually excited for the company as an investment option and what should they be looking at for the company for today or near term for any new offerings or new upcoming features. Yeah.
Yeah, so from our perspective, I highlighted this earlier at SGX, is that we're the only SaaS company to be listed on SGX. There's a lot of excitement. When we did the dual listing, to only institutional investors. It's multiple times oversubscribed because they do recognize that we are a very unique company, have a very strong Asia-based IP generation and presence and high growth, but yet a very, very global company. So that's very unique. We have 14 research coverage today. The blended average price guidance is about 1950 US dollars. Right now we're at 13. So there's a massive upside here. So we are the reason why we're working aggressively to get to our numbers internally, we call this escape velocity. We need to get to mid cap as fast as we can because size does matter to reduce the volatility. I think this year has been very, very volatile for the pre-mid cap and small cap tech companies overall in the equity market because it's very much sentimental driven this year. When ChatGPT 5 comes out, when Sam Altman say all software is going to be fast fashion, and everybody gets hit, right? So it's either you have a blockbuster and perfect print and perfect raise, otherwise you get penalized by the market. So the smaller the company, the more higher the volatility. So we are working hard to ensure that obviously we're not focused on the stock price today and to now. We're focused on our execution to get to the consistent, and we already have profitable growth, but to get to that escape velocity, so then we are less susceptible to the bigger swings in sentiments. So I think that's what I want to give everyone highlight is that we feel like right now we are underappreciated, but we just focus on execution. This is a founder-led tech company. The average tenure for all our senior leadership is effectively 15 years and above. So there's a lot of history and consistency of technical execution and performance. And for the first time, we have never borrowed money, we never had debt, but for the first time we have massive amount of capital and we have this consistent growth. And of course, SGX has been a fantastic branding exercise for us in ASEAN. So we want to take advantage of this momentum to further grow our business. So we're excited to be in this market. We're excited to be interfacing with investors in this market on now going forward quarterly basis. We think we have a very unique story to tell. And this is why we think we're very much worth your time.
Right. Thanks, TJ and Jim. So for ending off, I'll also still share the slide once more. If you are now convinced by the team, for the company on buying avepoint as one of the options, you can always use this voucher or this opportunity. All right. So if you scan the QR code, you actually get a cash voucher on the Poems 3.0 app. And then if you do buy only trades for cash trades, not SRS or CPM, only cash trades, then you will then be eligible for up to $20 worth of cash rebate if you do the trade within the next 30 days. And the rebate up to the contract value of $20, whichever is higher, will be credited to your account within 5 working days of the eligible trade done completion. Yep. So thanks for the team. Thanks, TJ and Jim, regarding sharing and also helping us to give us more context on this avepoint and how it's a viable investment option for everyone. So I hope everyone have a great evening and session joining us. All right. Thanks, TJ and Jim. Anything you want to share for our last moment?
No, I think we're over time, but thank you everyone for your time
Yeah.
tonight. And good evening.
Yeah. Thanks everyone for joining us.
Thank you.
Slightly over time.
Thank you.
Yeah.
Yes.
Have a great evening ahead, and I hope everyone have a great investment journey as well. Thank you.
Yes. Thank you.
Thank
Bye-bye.
you. Bye now.
Okay.